On January 15th, 2026, BlackRock reported record assets under management of about $14.04 trillion, while its research team publicly said it's tactically underweight long-term US Treasuries. At the same moment, total US debt sat around $38.45 trillion. The 10-year Treasury yield was hovering a little above 4% in mid-January, and the US dollar had just logged its steepest annual drop since 2017. Gold, meanwhile, just printed a record above $4,600 an ounce. That sounds like money leaving America. Yet BlackRock's own outlook still leans risk on in areas tied to US equity growth. Two facts that shouldn't coexist, unless the move isn't a flight. It's a rotation, and pricing says what words won't. Reuters +5. Now about that viral claim. BlackRock moved $2.1 trillion out of America. That line spreads fast because it feels like a switch got flipped, like a single decision that changes everything. But institutions like BlackRock don't flip switches. They turn dials, and the dial that moved wasn't America versus the world. It was duration. Duration is a boring word with explosive consequences. It just means time risk in bonds, how sensitive a bond's price is when yields move. Long duration treasuries move a lot when rates change. Short duration treasuries don't. Translation: BlackRock didn't leave the United States. It trimmed exposure to the part of the US market that can hurt the most if yields back up again. Think of it like this: a bank offers two loans. One locks you in for 30 years. The other resets in 5. If the world gets weird, which loan carries more unknown unknowns? That's duration. So the real story isn't 2.1 trillion fleeing. The real story is that the biggest asset allocator on earth is saying, in public, that the long end of the US curve is no longer the clean hedge it used to be. And that matters because the long end is where the system stores confidence. This is where the video gets useful. Not because it tells anyone what to do, because it explains what the system is doing. And what tends to reprice when the system turns that dial? Stay for 3 signals that separate a normal diversification trade from a confidence shock. Because those 3 signals decide whether this rotation stays contained or spreads into everything else. First, the mechanism. Why long-term treasuries suddenly look riskier even without any dramatic default story. Start with the math nobody wants to say out loud. Debt doesn't break countries by itself. Servicing costs do. When total debt climbs into the high tens of trillions, tiny changes in yields translate into huge changes in interest expense over time. The market doesn't need a crisis headline. It just needs auctions that clear at worse prices. Picture a warehouse that has to ship more boxes every week. But the number of trucks doesn't grow. The system still ships. It just starts paying more per truck. That's the bond market when supply keeps rising, and the marginal buyer becomes more price sensitive. Now add the second layer, the AI build-out. BlackRock's own outlook frames the AI cycle as front-loaded investment with back-loaded revenue. In plain English, massive spending happens first and payoff comes later. That creates a financing hump. Think of it like building a stadium. The concrete, steel, and labour costs hit now. The ticket revenue hits later. The builder usually borrows in the middle. AI is that stadium, but scaled across data centres, power grids, chips, cooling, networking, and land. So you have governments issuing more debt and companies issuing more debt in the same era. That's not automatically bearish. It can be growth positive, but it changes the price of capital. And when the price of capital changes, long duration assets get repriced first. Long bonds, long growth equities, anything that depends on far future cash flows. That's why this isn't a one asset story. It's a discount rate story. Quick checkpoint. So far the picture is simple. More issuance, more financing needs, more sensitivity to yield spikes. That doesn't mean collapse. It means the market demands a higher term premium, a fancy phrase for pay me more if you want my money for 30 years. Now, signal number 1 to watch is the most boring looking thing on earth. Treasury auctions. The long end doesn't move because someone posts a chart on social media. It moves when auctions start tailing. A tail is when the bond sells at a higher yield than expected. That means weaker demand. The market had to cheapen the bond to clear it. Translation: the system is paying up to get funded. If that becomes a pattern, especially in 10, 20 and 30-year supply, the long end can rise even if the central bank is cutting short-term rates. That's the first contradiction that catches investors off guard. Cuts don't always mean long yields fall. Sometimes they don't. Sometimes the long end says, "We'll take your cuts," and still demand more compensation for time. And that's exactly why big allocators can prefer short-term bonds for income while staying cautious on long-term duration. Think of it like a landlord offering 2 leases. A 1-year lease can be repriced quickly. A 30-year lease can't. If inflation is uncertain, the long lease needs a bigger premium. That's duration risk in one sentence. Echo 1. Remember the promise. 3 signals that separate a normal diversification trade from a confidence shock. Auctions are signal 1. The next 2 are where it gets sharper. Now step back and ask, why did the money-leaving America narrative explode in the first place? Because at the surface level, a weakening dollar plus a big institution underweighting long-term Treasuries sounds like a vote of no confidence. But the dollar can weaken for reasons that aren't panic. It can weaken because growth is spreading. It can weaken because rate differentials are narrowing. It can weaken because investors are hedging currency exposure. It can weaken because the US ran a strong decade and other regions are catching up. The key is to separate dollar down from system breaking. And that leads to signal number 2, currency hedging. When international investors buy US assets, they often hedge the currency. When they hedge more aggressively, it can put pressure on the dollar, even if flows into US assets stay strong. Translation: the dollar can fall even while America still attracts capital. That's why dollar down isn't enough. The question is, what's the behaviour behind it? A useful way to frame it is this. A risk-off flight usually pushes the dollar up, not down, because the dollar is still the world's primary funding currency. So if the dollar is down hard while US equities are still strong, that's not a clean fear trade, that's a positioning trade. Pricing says what words won't. Now, what does that positioning trade tend to reward? It tends to reward foreign earnings. It tends to reward commodities priced in dollars. It tends to reward parts of the equity market with real cash flows, not distant dreams. And it tends to punish portfolios that assume Treasuries always hedge stocks. Because in a world of rising issuance and sticky term premium, stocks and bonds can fall together more often than people are used to. That's not a prophecy, it's a regime shift risk. So if auctions are signal 1, and hedging behaviour is signal 2, signal 3 is the one most people miss. Corporate spreads. Spreads are the extra yield corporations pay over Treasuries. They measure perceived credit risk and liquidity stress. In a normal diversification rotation, spreads stay calm, even if Treasury yields move. In a confidence shock, spreads widen. Fast. Think of spreads like the crackling sound in a house before a power outage. The lights are still on, but the wiring is stressed. If spreads start widening while Treasury yields are also rising, that's when financial conditions tighten, and that's when the rotation stops being quiet. Now take a breath, because the point here isn't doom. The point is classification. If spreads stay contained, the system is digesting higher yields. If spreads blow out, the system is choking on higher yields. That's the difference between rebalancing and repricing. And that's why the headline number, 2.1 trillion, matters less than the plumbing. Now let's connect it to the parts of the market that actually move first. Start with the obvious. Precious metals. Gold doesn't need a recession to rally. Gold needs a credibility question. Gold moves when the market senses the purchasing power of paper promises is being diluted, or when real yields stop compensating for uncertainty. It's why gold can rise even when nominal yields rise. It's not always about rates. It's about trust. Silver is the same story, just more volatile because it's smaller and tied to industrial demand. Think of gold as an insurance policy. Think of silver as the same policy, with leverage and mood swings. Now fold in international equities. International markets can outperform simply because starting valuations are lower. They can outperform because currency translation helps. They can outperform because their sector mix is different. More banks, more industrials, more exporters, fewer mega-cap tech monopolies. This is why a global allocator can stay positive on US equities while also broadening country exposure. It's not betrayal, it's dispersion. Like a farm planting more than one crop. Same farmland, different harvest cycles. Now the part that makes most investors uncomfortable. US equities. Because the narrative becomes binary, either sell America or buy America. Institutions don't think that way. They think in factors. They'll stay overweight what's working, like profitable AI-linked cash flows, while hedging the part that's most vulnerable to a rate shock, like long-duration bonds. That's a barbell. Risk on in selective equities, risk managed in fixed income. So the opportunity set isn't leave America. It's stop assuming one hedge fixes everything. Which brings us to the midpoint tension. Because there's one event that can force this whole rotation to accelerate. If the next wave of Treasury supply clears with consistently weak demand, the long-end yield spike won't be the last. That's the cliffhanger. Simple, mechanical, not dramatic. And it creates the next question. Who absorbs that supply? There are only a few candidate buyers. Domestic institutions, banks, pension funds, insurance companies, households, foreign official buyers. If foreign official buyers are less enthusiastic and domestic buyers demand higher yields, the price adjusts. Again, pricing says what words won't. Now let's make this practical, at the system level, by walking through 5 areas that tend to respond to this exact mix of forces. Not recommendations, not guarantees, just the map. Area 1, short duration income. When term premium rises, the front end can offer competitive yield without the same price risk. Think of it like choosing a shorter contract when the world is uncertain. The income can be similar, but the what-if risk is smaller. Area 2, quality credit, selectively. If spreads stay calm, higher yields can mean better compensation for taking corporate risk in higher quality balance sheets. But this depends on signal 3. If spreads widen, that area changes quickly. Area 3, global equities with real earnings. A weakening dollar plus attractive valuations can lift foreign returns in dollar terms. It's not magic, it's translation. If a stock rises in local currency and the dollar weakens, the return compounds in dollar terms. Area 4, real assets. Commodities, energy infrastructure, and parts of the economy tied to physical constraints can benefit when capital gets more expensive and inflation risk stays alive. Think of it like renting a scarce tool during a construction boom. The price rises because the demand is real and the supply is limited. Area 5, the second order AI trade. The first order trade is chips and hyperscalers. The second order trade is everything that sells picks and shovels to the builders. Power, cooling, grid equipment, data center infrastructure, security. That's where the financing hump shows up in the real economy. And that's also why BlackRock's outlook spends time on private markets like infrastructure and private credit. The build-out needs funding channels beyond public bonds. Echo 2. Back to the promise. 3 signals that separate a normal diversification trade from a confidence shock. Auction health, currency hedging behavior, credit spreads. Keep those 3 on a dashboard and the noise gets quieter. Now it's important to puncture one more misconception. A lot of people hear underweight long-term treasuries and assume BlackRock thinks America is done. But BlackRock's business is global indexation and asset allocation. It holds US stocks because the world holds US stocks. It holds US bonds because the world holds US bonds. An underweight call is about relative risk and relative return, not an existential verdict. And the world BlackRock is describing is a world where the old 60-40 playbook is less reliable. Not a world where investing stops working, small cracks then big breaks. Unless the system patches the cracks early, that's the motif. A system can run hot for a long time. It only snaps when multiple stressors line up at once. So the question for 2026 becomes, are the stressors lining up or dissipating? We already have the debt load. We already have the financing hump. We already have term premium pressure. What changes the path is demand. That's why auctions matter. Now let's zoom out for a second and explain why the long end is the battleground. The short end is mostly a policy rate story. The central bank has influence there. The long end is a credibility story. The market votes there. When investors demand higher compensation to hold 30-year paper, it's not because they think the country vanishes tomorrow. It's because the future is uncertain, and uncertainty has a price. If inflation reaccelerates, long bonds get hit. If inflation collapses, long bonds rally. If growth is fine but issuance explodes, long bonds can still struggle. There are more paths where long bonds disappoint than most portfolios are built for. That's why the underweight matters. And it's why the viral 2.1 trillion misread is actually useful. Because it forces attention onto the right lever: duration. Now, what would invalidate this whole concern? Simple. If long auctions stay strong, tails stay small, and real yields stabilise without spreads widening, then the underweight can remain a tactical choice, not a systemic alarm. If, on the other hand, auctions get worse, hedging demand rises and spreads widen, then this rotation can ripple into equity valuations, housing affordability, and corporate refinancing. Because capital is the oxygen of the system. And when oxygen gets pricier, weaker business models get exposed. That doesn't mean everything crashes. It means the market stops paying any price for future cash flows. It becomes choosy again. Now the ending matters, because this story can easily become clickbait in the wrong hands. So the closing frame is disciplined. This isn't BlackRock moving out of America. It's BlackRock naming a constraint. High debt, plus heavy issuance, plus a financing hump makes the long end of the curve more fragile. That fragility creates opportunity in dispersion. Across countries, across sectors, across duration. Across financing channels. Follow the money, find the pressure. And the pressure right now is telling the same story in multiple places. Before the final wrap, a quick scorecard. 3 lines that keep the narrative honest. Treasury auctions, demand is the test, watch tails and bid strength. Credit spreads, calm means rotation, widening means stress. The dollar, weak can be normal, but disorderly moves change everything. That's the dashboard. And the payoff is exactly what was promised. 3 signals that separate diversification from a confidence shock. Signal 1, auctions. If long supply clears cleanly, the system's digesting the issuance. Signal 2, hedging behaviour. If hedges rise while US assets stay strong, it's positioning, not panic. Signal 3, spreads. If spreads stay tight, the move is contained. If they widen, the repricing spreads. That's it. No fear theatre, just the mechanism and the map. Because the biggest moves in markets rarely announce themselves with a siren. They show up as a small dial, turning until the whole room notices the temperature changed, and pricing says what words won't. ES retention V3, ES pacing V3.